Okay, I think that I am live. All right, so if you're tuning in and you're not on the live stream, welcome to the live stream. I'm just going to take a couple of minutes and let people get notified that we just started. And yeah, so let me just see that this is working. And go over here, get a shareable link. So if you're tuning in already, I'm just going to let you guys know that Jake is not going to be here. He is in London on a vacation. Jake is on vacation. We basically forced him to take a vacation because the guy works way too hard, and so it's just going to be me. Next Saturday, Jake will be here with me. But hello everyone. Looks like we're getting some comments. How you guys doing this Saturday morning? All right, I'm just going to share this link again. Okay. Talk about Zscaler. I'm just going to give people a couple more minutes to join in here. Share the link. Zscaler is a great one. All right, we're going to take a look at it. I'm just going to share one more link here. All right. Cool. Okay. Hello, Amit Invest, Marco Venki. All right, we're going to talk about Zscaler now. So I'm going to share my screen. Let me just figure out how to do this. Share screen. This one. All right. Okay, so you said you wanted to take a look at Zscaler. ZS. Oh, this company is the one that just reported earnings not too long ago, hey? I think that, yeah, they reported earnings and the stock is up like 22% on the day. Thank you, Kaler. Yeah, I believe that this one is a cybersecurity company. If we go over to the profile here, we should be able to engages in the provision of cloud-based security platform. Yeah, so they're a cloud-based security provider. Now, the cloud-based sector is growing like so freaking quickly. Online security is growing so fast. I actually own two businesses in my own personal portfolio that are exposed to this industry. And yeah, I mean, take a look at this revenue growth. This company was doing, what is this? $23.6 million in revenue back in 2016. And then in their most recent quarter, actually, this might be Q1, but in their most recent quarter here on Stock Unlock, $286 million in revenue, 287 million. So they've like 10x'd their revenue, more than 10x'd their revenue in 6 years. That's really good. And what's interesting about these businesses, most cloud businesses, typically they have very low costs of revenue, which means that they're very profitable. Their operations are typically very profitable. I mean, right here you can see that their cost of revenue was $64 million versus revenue of $287 million. So they had a gross profit of $223 million. If we go over to the metrics, yeah, that's a 78% gross margin. That is ridiculous. And that's what I mean. These software companies are just so freaking profitable. One thing that you do have to watch for on these businesses, though, is typically the selling, general, and administration costs are very high. And this is usually because the company is doing a lot of stock-based compensation. Stock-based compensation on the income statement goes under the selling, general, and administrative expenses right here. And that's why you can see that the total operating expenses were $309 million, which is actually more than the revenue. So this company's operating income is negative. So that's definitely something you want to watch out for. Is typically these high growth companies that are in the tech sector do have a lot of stock-based compensation. And if you go over to the cash flow statement and you take a look at the cash from operating activities, it's a very big discrepancy from the operating income. So for example, right here, we can see that this quarter, Zscaler did $77.2 million in operating cash flow, okay? But remember, the company had a negative operating income. negative $87 million in operating income. So there is a massive difference between the operating income and the operating cash flow, because on the cash flow statement, they add back in the stock-based compensation. So if you see that massive discrepancy, then it probably tells you that there's a lot of stock-based compensation going on, which we could also probably check with the diluted shares outstanding. And you can see that the shares outstanding are increasing over time because this company is most likely doing stock-based compensation, which is diluting shareholders. But you know, it's kind of a catch-22, because a lot of these companies, they do lots of stock-based compensation because that's how they retain their talent and their employees. So it's kind of a trade-off, but I mean, when you're taking a look at the underlying fundamentals of this business, the revenue, cash flow, everything like that, it is growing very quickly. And yeah, I do really like the online cybersecurity space. The company that I own, well, I own two of them, as I said, but the one that I own is Magnet Forensics. This is a Canadian company, and they grew revenue, I believe, at something like 40% year over year, and they increased their guidance in their last quarter. I was buying this stock down here in the 16 and $15 range, and now it's up. I think it's up like 40 something percent, but this is another cybersecurity company. It's a smaller cap one, but it's just growing ridiculously quickly as well. And yeah, this sector is just awesome. Okay, looks like we have some more people joining. Could you maybe analyze some of those? Thanks for all the quality content. All right. So, what do you guys think about the cybersecurity market? Is it just Zscaler that you're paying attention to, or are there more stocks that you would like me to take a look at here? I'm actually going to go and take a look at Zscaler's um, price to free cash flow, because these stocks usually trade at very high prices. Yeah. So, for example, you can see here that Zscaler is trading for a price to operating cash flow of 83. That's very high. If we go to price to free cash flow, yeah, 118. What is the actual market cap of this business today? About $22 billion. Okay, what's the revenue? About a billion. So this company is trading for, what is that? That's like 20 times sales. So yeah, that's a pretty expensive business in my opinion. I mean, the growth is there, but it's still very expensive, and this is typically what you see. Can you please explain the logic behind profit negative and cash flow from operations positive? Yes. So if the operating profit or the operating income is negative, let's go back to Zscaler here. So if the operating income is negative, but the business is producing positive operating cash flow, as I said, it's most likely from this right here, the selling, general, and administrative expenses. And this is subtracted from the income statement, but it's not actually a sorry, what I'm talking about here is the stock-based compensation, because stock-based compensation is in this expense right here, the selling, general, and administrative expenses. So it is subtracted from the income statement, but it's not a real cash expense to the business. What it is the business diluting to give their employees stock. They're essentially compensating their employee with dilution and with stock. So the business isn't actually spending its own cash to do that. So on the cash flow statement, this expense is added back because it's not actual cash flow. But on the income statement, it is removed from it's an operating expense, and it's reported as an operating expense on the income statement because it is kind of an expense still. Like, it's an expense to shareholders. So here on the income statement, you can see that the operating income was that negative $86.6 million because there's a lot of stock-based compensation going on. But then on the cash flow statement, that stock-based compensation is added back on to show you the actual amount of cash that the business produces from its operations. And here you can see that in the first quarter, it looks like the operations actually produced about 77.2 million when you add back in that stock-based compensation. So yeah, if you see that, that's what I mean, is if you see that massive discrepancy between the operating income versus the operating cash flow, most of the time, not all the time, but most of the time, it's due to a lot of stock-based compensation. So it's just something to watch out for. And then in conjunction with that, you can take a look at these shares outstanding and see if these shares outstanding are growing over time, because when there's stock-based compensation going on, it is dilution and it will increase the shares outstanding. So yeah, that's just something you got to watch out for. Definitely something you should be aware of if you're investing in businesses like this. Okay, I'm seeing a quick one here. What are my thoughts on IIPR? So this company, it's actually in the cannabis space. They essentially like they own cannabis grow facilities, I believe. I'm going off memory here, and they lease out these cannabis facilities to cannabis companies, and that's how they make their money. Now, this company right here has a dividend yield of 7.4% today. All right. And the stock has come down freaking massively. It's down like 70% now. This is actually a stock that I owned at one point as well. But the reason that I sold it and I don't own it anymore and I'm not looking to buy it is because the cannabis industry in the United States, like there's only two profitable cannabis companies that I know of. And that's Trulieve when they are done digesting the Harvest acquisition and Green Thumb Industries. So if there's only two profitable cannabis companies in the cannabis space, and this company right here, IIPR, essentially leases out real estate to a bunch of different cannabis companies, then what that tells me is that IIPR is leasing out a ton of their real estate to companies that are not profitable. This is risky and this is a problem, in my opinion, because if these companies aren't profitable, then how long can they stay in business? And if these companies are unprofitable, they're losing money, then in my opinion, eventually they're going to go out of business. And when they do, IIPR is going to stop getting their revenue and their income from these unprofitable businesses. So, just to simplify what I just said, IIPR is essentially leasing out their real estate to unprofitable companies that are losing money and I don't think are going to stay in business forever, which adds a lot of risk to IIPR, in my opinion. I think this is why the stock has been sold down so massively. And even at a 7% dividend yield, I'm not confident that this dividend is going to remain just because so many of their tenants are losing so much money and that just cannot continue forever. So something's got to change here. And yeah, so that's why I don't own IIPR. What are my thoughts on figs? So I did an interview with Brian Feraldi over on my personal YouTube channel, Daniel Pronk, and he basically said that I think he said that he owns figs, and then he was looking at another company with a ticker symbol U, literally YOU. And so I took a quick look into these companies. I must admit, I do like you better than figs, but let's just take a look at figs really quick. So we're going to take a look at our insights here, and this company does have a growth score of 5.0 out of 5, which is very good. So the revenue, net income, book value, and tangible book value are all increasing, and the revenue grew by like 30.6% over the past year. So that's pretty dang good. I mean, that's really strong revenue growth. The gross margin, 71%. Now, I believe that this business is in the like they sell. I hope my girlfriend isn't watching this live stream because I should know the word for this. But what nurses wear? I don't know why I don't know the word for that right now. But they sell they sell the scrubs. They sell the scrubs that nurses wear essentially. So they're like a clothing business, a clothing brand, but they have a 71% gross margin, which is like unheard of unless you're like a luxury clothing brand. That's a really strong gross margin. Now, their operating margin is only 11%, net margin 7%, and it looks like the company's free cash flow margin is only about 1%. So I believe that when I looked into this company, they didn't have a lot of free cash flow going on, and that's kind of why I wasn't so interested in it right now. However, the financial health of this business is insane. They have a 5.4 current ratio. They're debt free. Their shares did increase by 20% over the past year because they did an IPO, which diluted their existing shareholders and they raised a ton of money through that IPO. And they have more cash than total liabilities. So this company has, what is that, 2 times as much cash as total liabilities. Okay. So they're in a very solid financial place. So in terms of like the business going under or anything like that, I don't think it's going to happen anytime soon. So let's go and take a look at their financials here. And we can see that the revenue is growing quite significantly. I mean, if we take a look at the trailing 12 months, this company just IPO'd, so they don't have a lot of history here. But I mean, the revenue grew from $263 million at the end of 2020 to $464 million today. So that's a pretty significant growth to revenue over the past 18 months. Let's take a look at their operating income. So operating income looks like it's kind of going down, but now it's coming back up a little bit all over the place. So what I really care about actually is the cash flow. And yes, so back here in the third quarter of 2021, this company was doing about $20 million in operating cash flow, but now the operating cash flow has basically tanked. It's all the way down to negative 18.5 million in the last quarter. And in the trailing 12 months, they produced about $7 million in operating cash flow. I don't love that because my investing style is I'm a cash flow investor. I really care about cash flow. So I don't love to see that the company's cash flow is not growing, or at least its operating cash flow. But yeah, here, I mean, we can see that the company has total cash of $170 million, which is significant. Total assets of 354 million and total liabilities of 75 million right here. So this is what I mean. This company has total liabilities of $75 million, right? And they have cash of 170 million. So, I mean, they could pay off all their liabilities right now and still have like $95 million of cash left, which is a decent amount of cash. So yeah, I think that it, like, to me, this looks like a typical growth business where it's growing really quickly. It does have a strong gross margin, which does give me confidence that, this business is high gross margin could most likely translate into a high operating margin and a high net margin in the future. But right now, it looks like this business is focused on a lot of growth, and it's just really focused on growing that top line with not really that much operating cash flow. So it looks like your typical growth stock, which is just not really my thing that much. I'm just going to be totally honest. Like, I don't know. They're harder for me to understand, I guess, and evaluate because I mean, yeah, it's just harder. But this stock's been freaking tanking in the market. I mean, it's down 72% over the past year. The fundamentals do look decent. It is growing. It's got a really strong balance sheet, but I'm just not sold on it yet. I'm personally, I'm just not sold on it yet. Scrubs, thank you, Alex. So by the way, you guys, I can't see your comments when I'm talking. So uh yeah, I'm sorry. Thank you, Alex, for telling me that they're scrubs. As I said, my girlfriend would be so mad at me if she was watching this right now because her family is all in the medical industry. Her mom's a nurse, her sister's a nurse, and she is working in the hospital as a physio. And I didn't know the word scrubs. So yeah. All right. Let's continue on. Can I look at Okta? Oh, okay. I've got to scroll up a little bit here. We're going to take a look at CrowdStrike is another cybersecurity company, which we've already taken a look at Zscaler. So Crowd is a larger cybersecurity company. I believe the stock IPO'd here in 2016, or sorry, 2019. And now it's up about 100, what was that? 190%, I believe, around there. Yeah. So about 160 to about 160% from its IPO. So this company is seeing a lot of growth to its stock price over the past 3 years. And what's interesting about this one is we really saw this like massive correction in growth businesses over the past, like, I don't know. I'm going to say over the past like 15 to 18 months. I mean, I'm sure we all saw it. Growth stocks like Zoom, DocuSign, all those companies, Shopify got slaughtered, right? But what's interesting is CrowdStrike, in terms of being a really high growth business, it's only down 40%. Now I say that because these other companies like Shopify are down like 80%, right? So this company does look like it is holding up better than the other stocks, the other super high growth stocks in the market. Now, the profitability of this business is a 2.6 out of 5, which is okay. Gross margin is very high at 74%. Operating margin and net margin are negative, but it does have a very strong free cash flow margin of 30%. So 30% of the revenue essentially is actual cash flow for this business, that's honestly, as a cash flow investor, I really like to see that. Now, the financial health 3.3, current ratio is 1.8, which is decent. Has low intangibles, well, an average amount of intangibles at 12%. The shares have increased by 2.7% over the past year. This is most likely from stock-based compensation. And the company has more cash than current liabilities. So they're not in any financial stress right now. But however, take a look at this growth, okay? Growth score 4.6. Revenue grew by 61%. Net income grew by 7%. Free cash flow grew by 50%. Book value grew by 35%. And tangible book value grew by 62%. So this is another company right here that's just growing so incredibly quickly, right? And I mean, when you're an investor, you really like to see growth in the businesses that you're investing in. So Take a look at this as well, all right? This company did $38.7 million in revenue in the first quarter of 2018. And then the last quarter, they did $535 million in revenue. That's a lot of revenue growth in 4 years. Like, man. In the trailing 12 months, $1.83 billion in revenue versus 208 million in 2018. So that's like they've like 7x to their revenue in 4 years, less than 4 years. That's really strong growth. Let's take a look at the gross profit. This is the same story with the gross profit. Gross profit's actually up 10x over the past 4 years. But this is another business right here. This is what I mean. Its operating income is negative. And I imagine that this is from, selling general and administrative expenses are $1 billion in the trailing 12 months. And I got to imagine that most of this is stock-based compensation. So once again, we can see that the operating income here is negative $136 million. If we head over to the cash flow statement, cash from operating activities in the trailing 12 months was $744 million. So you're seeing that massive, massive discrepancy between operating income and operating cash flow. We also saw that they diluted by about 2.7% over the past year, which does tell me that this business is most likely doing a lot of stock-based compensation. Now, we can see that free cash flow. Free cash flow is growing, and you can see that, okay, so this business was running free cash flow negative in 2018, and then you can clearly see that there was this inflection point in 2020 where the business started producing free cash flow, and every single quarter, the free cash flow is now growing. In the trailing 12 months, it's now $542 million. That's really strong growth. Like, honestly, this company looks very attractive from a growth and a cash flow standpoint. You do got to factor in that dilution that they're doing with the stock-based compensation. But I mean, it does look attractive from a growth standpoint. Now, this is the thing, though. This is the thing. Every time I look at one of these businesses, I'm like, oh man, it's growing so nicely. It's so attractive as an investment or as a fundamental business. But then I go over to our freeform tool, and then I always take a look at the price to free cash flow, and it's 77. Okay. 77.3. That's really high. That's really high. Price to operating cash flow, 56. So I mean, yeah, the growth is there. These businesses are very attractive, but I can't bring myself to pay these prices. Like, even if the free cash flow is growing, like 30-40% year over year, I still think that a 70 price to free cash flow is too high. I would be willing to pay like 30. I would probably be willing to pay 35 to 40 times free cash flow for this business personally, but not 77. I think that's just too much. Another really interesting company is Snow, actually. Snow is in the cloud computing sector. And this company is growing so freaking ridiculously. Like, revenue grew 92% year over year, okay? That's really strong revenue growth. Let's go to here, total revenue. Like, they've 10x'd their revenue in 3 years. Literally 10x revenue. $169 million in trailing 12 months revenue in 2019, and $1.64 billion trailing 12 months now. So 10x revenue in 3 years. But this company has a $60 billion market cap and is trading at like 40 times sales. It's just too much for me. I just can't do it. So yeah, that's kind of my opinion. Let me just take a look. Oh, hello, Sophie. Thanks for tuning in. Alex, you're buying figs? Nice. Okay. So, like, what is your bull thesis on figs, if you don't mind me asking? I'm sorry, I got to look at the second screen here to see your guys' comments, but yeah, let me know. Let me know what you think about figs. What's your bull thesis there? And I would love to hear, because I'm not entirely sold on the company yet. I do see its growth potential, but I'm not entirely sold on it yet. Very good cybersecurity is KNBE. KNBE. Okay, let's take a look. I guess we're talking about cybersecurity companies today, which is fine. I'm down. I'm always down. Okay, so this stock looks like it IPO'd in 2021. It looks like around $23. It's now at about $20. So its stock has held up well during its IPO, actually, over the past year. IPOs got smacked in the market, okay? So yeah, gross margin is 86%. That's a very nice gross margin. Free cash flow margin, 28%. I immediately like these, okay? Immediately like those. Revenue grew by 40%. Net income grew 147%. Book value increased by 35%. Financial health, current ratio is 1.6. They're debt free, cash more than current liabilities. So the financial health looks decent. Strong book value right there. Or sorry, strong balance sheet. So nothing really to worry about financially, at least in the short term. So okay, we're seeing strong revenue growth. That's nice. Income statement, quarterly. Okay, so they've essentially doubled revenue in like 2 years, which is pretty strong growth. That's actually really strong growth. Now, here's the moment of truth. What is the price for this business? Before we look any further into its financials, what is the price of this business? 42 times free cash flow. It's operating cash flow. 38 times operating cash flow. So that's better than CrowdStrike and Zscaler. It's better. Still kind of expensive though. 40 times free cash flow. It's really hard to find cybersecurity companies that are not trading at over like 40 times free cash flow. It's like everyone knows that this is a massive sector and is growing really quickly. So like everyone's already bought up all the shares in the stock. So yeah, I don't know. I don't know if I'd pay 40 times free cash flow for this business. I mean, we've taken a look at it for 30 seconds. So yeah, I don't know, but it does look attractive. I mean, it's got that really high gross margin, really high free cash flow margin, so it's very profitable, and it's growing really quickly. I mean, revenue grew at 40% year over year. So yeah, maybe it's a research candidate, and I just love how all these companies are growing so quick. Okay, Robert asks, cannabis legalization timeline, will it continue to grow and expand, consolidate, become profitable? So the cannabis industry is interesting. I mean, the reality is no one knows when it's going to be legalized. I personally think that cannabis is going to be legalized in the United States eventually. I don't know when. I don't think anyone can answer that. Um, but basically, what's going to happen and what's currently happening is these companies in the cannabis industry, like TrueLeaf, for example, let's go and pull up TCNNF, and let's go to their financials, and let's go to the revenue. So, what happens to these kinds of companies is you see this massive revenue explosion here. Like this company grew revenue by 10x in 2 years. This is because they have heavy exposure to Florida. Florida legalized medical cannabis use. So that one state had this massive growth potential for a few years. But until Florida legalizes recreational cannabis, I mean, the medical cannabis market in Florida has kind of just leveled off. So until there's another massive change in legislation of some sort, what happens to cannabis companies is they kind of see this like really big expansion of revenue, and then until there is a new progress in legislation, let's just call it, the revenue kind of just flatlines, which is exactly what we're seeing right here with TrueLeaf now. In the past 2 quarters, they've grown revenue by $15 million, which is like 5% over the past 2 quarters. And you compare that to 2018 versus 2020, where they literally 10x revenue in like 2 years. So they saw massive revenue growth. Now they're kind of saturated in the markets that they operate in until further legislation comes. And then they're probably going to see another massive growth to revenue. But in the meantime, this company's revenue isn't really growing. And that's kind of how the cannabis market works. So for me, I am invested in TrueLeaf. And for me, it's always been a long-term investment where I'm holding this stock because I think it's one of the best U.S. cannabis stocks to own, along with Green Thumb Industries. Those are the two that I own, and I've always been invested in these businesses for like literally the next 10 plus years because as I said, I don't know when cannabis is going to be legalized. I think it will eventually, but in the meantime, I don't know when it's going to happen. So I think that the long-term TAM is there, but when are they actually going to see that financial growth? I have no idea. So I'm just going to hold for the next like 10 years. With iteration, I totally agree with you. I think it's going to happen. I don't know when, but the momentum is there. The momentum is heating up. It's picking up, and I think it's just a matter of time now. And as an investor, I just got to stay patient. Thinking of buying BIP soon. Kaylor, are you asking me if I'm thinking of buying BIP soon, or are you saying you're thinking of buying BIP soon? Let me know. Personally, I love buying BIP on any freaking dip this stock sees, okay? Check this out. So this is one of my dividend income investments, and like this stock is so freaking consistent. Like back in 2010, this was a $6 stock, okay? And it's just ran and it just continues running, and now it's up like 600% over the past 12 years. It's an infrastructure utility business, incredibly boring. Every time I talk about this stock on my main channel, you know, no one seems to really care about it, which is fine. I get it. It's a boring business. But the returns that this business has seen speak for themselves. I think that it's an incredible business with a huge long-term potential. And yeah, at one point this was actually like one of the largest positions in my portfolio. It's not anymore because I've been adding to other stocks, but yeah, I'm very confident in this business long term and I just see its potential. So, sorry for the rambling. This business right here on April 20th this year was worth about $45 a share. And then it saw this huge correction of 20%. Now, relative to like Shopify, this is not a huge correction, right? 20%. For a utility business, though, that's like a stable utility business, this was a huge correction. So I used this correction right here to load up more shares. I increased my position in BIP, and yeah, I was literally buying like right here in the $36 to $37 range, and um, now it's up about 15, 16%. So I thought that the stock looked very attractive down in this dip, and I was buying this dip. And that's what I mean. It's like every dip that BIP sees, like right here in 2020, this is October of 2020, it saw about a 10% correction. And you can see that every single time this stock corrects like that, it's just a buying opportunity, in my opinion, not a financial advisor, but in my opinion, every time this stock sees a correction like that, I'm going to be a buyer. just just know that every single time BIP dips 10 to 20%, I'm most likely going to be buying with probably a 90%. You could make a bet and you would probably be right 90% of the time that I will be buying the dip on BIP. So that's kind of that's what I do. I just love this business. I think it's great. Um, what do we got next here? What do I think about Kroger? What do I think about SoFi? SoFi, I took a look at SoFi on my main channel about a few months ago, and I said that it was expensive because, I mean, SoFi is a bank. It's essentially a bank now, right? But it was trading at massive premiums to the overall banking industry. I think I was taking a look at it at like the $10 range. And I said that it looked expensive. I said back then that I thought the stock would be interesting around $5. It's not quite there yet, but yeah, it is an interesting stock. I don't know if I'll ever own it again. I did own it last year when I was kind of speculating a little bit more. I don't really speculate that much anymore in the market. I really try not to speculate at all, actually. So, in my opinion, I don't know if I'm ever going to own SoFi because I love Equitable Bank. I think Equitable Bank is a very strong business. It's like highly profitable. It's growing double digits, and I think that it's cheap. So when I compare my banking sector stocks, you got Equitable Bank versus SoFi. In my opinion, I think that Equitable Bank is a better long-term opportunity. And yeah, so that's just kind of my opinion. That's what I do in my portfolio. If I'm taking a look at SoFi, I got to compare it to a stock that I already own. And then it's like, do I want to buy SoFi or do I just want to buy more of the stock that I own that I have very high conviction on, that I definitely think that it's just going to continue growing for the long term. So do I want to add more to that stock that I'm very convicted on, have very high confidence in, or add to SoFi, which I'm not nearly as sure about, and I kind of think that it's expensive already. So yeah, in my opinion, I like Equitable Bank better, so I probably will not be buying SoFi anytime soon. All right, let's take a look. What's going on here? Any companies catch your eye? Okay, this person, Iteration, said, any solar companies catch your eye? I know you got rid of CSIC. Yeah. I let my Discord know. I think it was about a month ago. I sold Canadian Solar. I owned this stock for a very long time, but I sold Canadian Solar. So I was initially buying it like back here in $20, around $20 in 2020. The reason that I was buying it back then is because the company was selling for, I believe it was selling for like one times book value. It's in the solar industry, and I thought, solar is just going to be this massive industry that continues growing with the renewable sector. And to an extent, that did happen. I mean, if we take a look at this company's financials, um, we can see that revenue is like freaking exploding right now. I mean, take a look at that. Out of nowhere, this company in the second quarter of 2020 just did $2.3 billion in revenue. Okay. That's really, really strong revenue growth. If we take a look at the trailing 12 months, I mean, this company's never produced this much revenue, literally ever. So it's producing a record amount of revenue right now. $6.3 billion in revenue in the trailing 12 months. Very strong revenue growth, right? Um, One thing about this business, though, is that it does have a lot of cost of revenue. So it costs this company a lot of money to build solar panels and ship them around the world to their customers. So the gross profit right here is 1 billion. And if we take a look at the metrics, gross margin is about 17%. So it's not a very highly profitable business. And if we take a look at the operating income, I mean, the operating income in the trailing 12 months was about $252 million. And if we go to the metrics, what is the operating margin? Operating margin is about 4%. So that's what I mean. It's not a very highly profitable business. And the thing about this is, I think sometime in 2021, I really started focusing on cash flow more. And the reason that I did that was because Warren Buffett has this one quote, and he says that he values businesses based on how much cash they can return to their shareholders over the long term. And that really switched my thinking from net income. Also, Warren Buffett, in his 2019 letter to shareholders, wrote that net income is not the best metric anymore because there was this change in sometime in 2018 where companies now have to report unrealized gains and losses against net income or for net income. And it caused net income for some businesses to it's just too volatile now. And it doesn't really show you the actual cash flow generation of a business anymore. And as I said, this happened sometime in 2018, I believe. So if we go, not Brookfield, what am I doing? Berkshire. So if we go to Berkshire Hathaway quick, I'll show you exactly what I mean. If you go to the income statement here and you go to the net income and you go to quarterly, take a look how volatile Berkshire's net income is now. Okay. So in 2019, at the end of 2019, the company did $29 billion in net income that quarter. And then the next quarter, just one quarter later, in the first quarter of 2020, negative $50 billion in net income. So it went from literally $30 billion in net income in the fourth quarter of 2019 to negative $50 billion. That's an $80 billion difference to net income quarter over quarter, because what happened in the first quarter of 2020? The stock market fell, the stock market crashed. And Berkshire Hathaway owns so much stock that they don't plan on selling, hopefully, ever. So what happened is in the fourth quarter of 2019, stocks were up. So they reported that unrealized gain on stocks as net income. And then the first quarter of 2020, the stock market crashed. So their stock portfolio fell by like $80 billion. And they had to report that unrealized difference in their stock prices against net income. So Berkshire Hathaway now has such volatile net income. And in my opinion, it doesn't really tell you the underlying cash generation potential of the business. There's another stock here. I own this one, Dream Industrials. Take a look at this. So this company, in the trailing 12 months, okay, they did $332 million in revenue. All right. Now let's take a look at their net income, because they did essentially $1 billion in net income. So think about that. $300 million in revenue, $1 billion in net income. How did they make three times as much net income? It's because it's a real estate company. And over the past few years, with low interest rates, real estate prices, so their real estate assets, their value just went up dramatically. And what happens with this new accounting rule is when their real estate appreciated in price and gained value, they got to report that as profits. They got to report that as net income. But that's not actual cash flow. That's just their assets gaining value and they're reporting that as net income. So, in my opinion, that does not tell you how profitable and how much cash that business can actually generate. I mean, take a look at this now. This company is selling for a price to earnings ratio of 3 because of this. That's ridiculous, all right? A price to earnings ratio of 3. So yeah, the whole I'm rambling, but the whole moral of that ramble was that net income is not the most reliable metric on most businesses now. So when we go back over here to Canadian Solar, let's actually go and take a look at it in the freeform tool. And we're going to take a look at its price to earnings. Because I believe when I started buying this stock, it had like a price to earnings of under 10 in 2020. Yeah. So I was buying it around here, and the stock at that time had a price to earnings ratio of 5.4. Now, me, not really understanding this earnings net income thing back at the time, I saw a price to earnings of 5.4. I believe the price to book was also around 1. Yeah. So price to book was around 1. Price to earnings was around 5.4. So I was like, man, this is a serious value investment, right? But the thing about this business now, and the thing about my investing style, is this company doesn't report cash flows. So if you go to cash flow, there's literally nothing to report. There's nothing here. So I don't know. I mean, this company can say that they're profitable, they're generating all of these earnings, but I don't know, because earnings, in my opinion, can be heavily manipulated now. And they depend so much on unrealized gains and losses of assets that I don't actually know how profitable this business is, because they don't report cash flows. So as someone who tries my best to emulate Warren Buffett and ask myself, how much cash can this business return to me? With Canadian Solar, it's a question mark. I don't know. I I really don't know. And I can't answer that question anymore. So for me, I thought that this business became a lot more speculative, and that's just what it came down to. And with me trying to remove all the speculation out of my portfolio, I had to let it go. And it's really sad, because, I've held this stock for over 2 years now. But it is what it is. So yeah, that was a long answer, but I hope that answers why I sold Canadian Solar. All right. Oh yeah, thank you, Iteration, for that question as well. So now another business to look at. Daniel, can you please walk us through an example of how you use the DCF? Would you like? I'm just trying to catch up on all the comments, guys. Sorry. That's on FLG MCB. Daniel Workman says Dream Industrial has a price to cash flow of 17.21, which historically is pretty good. I agree. Sorry, my voice there. I agree. I think Dream is pretty attractive right now. I'm honestly a buyer. Full disclosure with you guys, I've been dollar cost averaging this stock, because the dividend yield right now is nearly 6%. So in my tax-free savings account, I load it up on Dream because I don't get taxed on dividends in that account. So I'm essentially getting a 6% monthly dividend. Well, it's a 6% annual dividend paid out monthly, but I get that dividend payment every single month tax-free in my TFSA. Pretty awesome, right? This stock is selling like 30% below book value now as well, because everyone's a bear on real estate. I mean, this stock dropped like 30%. It's got a book value per share of over $16, and it's selling for $12 now. So it's selling like 30% below book value, 6% dividend yield. They're growing cash flows. Like, I had to buy some more, FFO payout ratio is over 100%. Yeah. FFO is a weird metric, you guys. I've taken a deep look into FFO. It's a weird metric. I prefer operating cash flow. And if you go to the company's financials and you take a look at the operating cash flow in the trailing 12 months, it's $189 million. And I believe that their dividends paid is $121 million. So the company's operations generated about $190 million, and the dividend payments cost about $121. So in terms of the company's operating cash flow, it does seem fine. And I believe that the free cash flow is also 189 million. So in terms of free cash flow, the company can pay out its dividend. And yeah, but FFO is just kind of a weird metric. Okay. What are my thoughts on Palantir? I think Palantir is an interesting company. It's growing really quickly. But man, that company has a lot of stock-based compensation going on. I mean, if we go and take a look at the income statement here quarterly, and we take a look at the shares outstanding, I mean, the shares outstanding in 2020 was 1.65 million, and they've grown to 2.05 million now. So over the past 2 years, that's like 20 to 30% dilution, all in stock-based compensation. There's a lot of stock-based compensation going on for this business, which does suck because its gross margin is very high at 79%. Like, this is a very profitable business, but they just dilute their shareholders so freaking much, and it makes me sad. They did $292 million of operating cash flow in the trailing 12 months. What is the business's price now? $16 billion. So that's like, what is that? What is their price to operating cash flow today? Price to operating cash flow, what is happening here? Is 53. I still think that's very high, personally. I think that's very high. And also the company, I believe they lowered their revenue guidance. Get that out of here. I believe they lowered their revenue guidance for the year as well because they were saying they're going to grow revenue at 30% a year for like 5 years, and now they're saying they're not going to do that. I don't know. I think that the stock is quite speculative, to be honest. Yeah, that's just my opinion. I really don't like the amount of dilution and the price going on with it. Let's take a look. Just reading some comments, you guys. Okay, Daniel, can you please walk us through an example of how to use the DCF? Yeah, sure, absolutely. Let's go and take a look at one of my favorite stocks right now, EQB.TO, Equitable Bank. And let's go and take a look at the DCF. Oops, I should just type that in here. Okay, so DCF, this is a bank. So for banks, I do not use any cash flow metric because cash flows on banks are just all over the place. So for banks, I use earnings. Now, over the past 10 years, what Stock Unlock does here is we take the historical 10-year growth rate on average and we just enter that in for you. But in my opinion, I don't think that Equitable Bank is going to grow at 15%, their earnings at 15% a year over the next decade. They could, but I like to be conservative when I do this. So I'm going to say that Equitable Bank is going to grow their earnings at 10% a year over the next decade. We're going to do 10 years. And the shares outstanding growth rate, this company does dilute a little bit because they do acquisitions. And when they do acquisitions, they do dilute. So over the past 10 years, they've diluted on average 1.3% a year. I'm just going to leave that because, again, I think this company could dilute a little slightly in the future as well. Now, the price ratio, over the past 10 years, this company has had an average price to earnings of 7.24. Okay. So this is how the market has historically valued this business. I'm going to be slightly conservative and just say 7. So in the future, I'm expecting this company to have a 7 price to earnings ratio is essentially what I'm saying. And the discount rate is the rate of return that you want on this investment. So the rate of return that you want on this stock. For me, I want a 10% rate of return. That's my discount rate. And when I enter in these metrics right here, so I'm saying that Equitable Bank is going to grow its earnings at 10% over the next decade. They're going to slightly dilute. They're going to trade at a 7 price to earnings ratio, and I want a 10% return. And then what our DCF calculator does is it takes all those metrics, factors them in, puts them in a calculation, and it says that the discounted fair value is about $54 a share, or about 1.28% above where the stock is currently trading. Now, personally, I think that these are more on the conservative end metrics right here that we inputted. So when I'm being conservative, it tells me that Equitable Bank is probably selling around fair value right now. And it also tells me that if I am buying the stock below this price, then I will get my 10% annual return on that investment. So that's essentially how this works. And then when you scroll down, you can kind of just see like, okay, if Equitable Bank actually grows their earnings at 10% a year over the next decade, what is that going to look like? And that means the company will be producing about $777 million in earnings by the second quarter of 2032, which honestly I think could happen. I mean, they're producing about $300 million in earnings right now. Over the past decade, they've grown their earnings by like 4x, about 4x. And for them to hit this rate here, they would have to grow earnings by about 150%, which is significantly lower than the growth rate they've had in the past. And this company has a lot of growth potential and growth avenues that they're exploring and expanding into. So I think that there's a very real chance that this business could hit that 10% earnings growth rate over the next decade, if not more. So yeah, I like the stock, and I'm happily dollar cost averaging it in this price range, and that's kind of how I use the DCF. Now, let me just make sure we don't have too many more comments coming in. Okay. So another example here would be like Nvidia. I made a video on my main channel yesterday. Nvidia's free cash flow. So this company is seeing its revenue and its cash flows and its profitability actually decline right now. And the stock is still selling for a 50 price to free cash flow, which just blows my mind. It's way too expensive in my opinion. So over the past decade, Nvidia has grown their free cash flow at 26%, but right now the company's free cash flows are going down. So I'm going to say that over the next decade, the company is going to grow its free cash flow at like 10% because right now it's going down. And then if it can reverse that trend, then maybe it can grow its cash flows at 10% over the next decade. Also, I'm going to say that the stock is going to trade at a 30 price to free cash flow, which in my opinion is still rich for a company growing cash flow at 10%. We're going to say they're not going to dilute, and we want that 10% discount rate and return rate. And when I do this, NVIDIA, well, the DCF tool tells me that NVIDIA's fair value is probably around $75 a share, or about 47% below where the stock is currently trading. So I think that this stock carries a ton of risk just by doing some basic calculations here in the DCF, um, putting in what I think is a more realistic growth rate to the cash flow and still a rich price to free cash flow. It tells me that the stock is quite overvalued. Now, also, for NVIDIA to hit these projections, they would have to do about $16 billion in free cash flow by 2032. And the company is currently doing about six, so they would have to grow cash flow by about 150% as well. But again, the cash flow is currently dropping, as you can see right here. So if the cash flow drops by another like 30% over the next year, then they're just going to have to make up for that and grow even faster. So I think that there's a lot of risk with NVIDIA. And by using the DCF here and putting in metrics that I think are more realistic, maybe even a little bit more optimistic, it still tells me that the stock is quite expensive. So that's kind of how I use the DCF. All right. What is going on here? My thoughts on Salesforce. Salesforce ticker is CRM, I think. Yeah, CRM. So this stock IPO'd back in like 2004. It's up ridiculously well. Like it's up, almost 8,000%. And if we zoom in here, it topped out at $309 a share in November 2021, and now it is down. Oops. Now it's down about 50%. So it's lost about half of its value. So I can see why, maybe people are thinking the stock looks attractive right here. I haven't taken a look at Salesforce in a minute, but from what I remember, this stock is growing its revenue still. Yes. So we can see that the revenue is growing very, 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 very well. That's ridiculous. That is very ridiculous. Okay. So revenue is growing very well, very consistently. But if we take a look at the cash flow, this is the problem for me. The cash flow is not growing. So what this tells me is the company's margins are compressing because as the revenue grows, the cash flow is not keeping up with it. So if we go to CRM and we're going to graph the revenue and the cash flow. You can do it. And the cash flow here. So over the past decade, let's look at the past decade. So here you can very, very, very clearly see what's happening. The revenue is continuing to grow very nicely, but you can see that the cash flow here since about really over the past year, maybe even the past 15 months, has kind of just been flat. So the cash flow is really having a hard time growing. And that's what I don't like to see. It's to free cash flow. Let's take a look here. And it's still selling for about a 28 price to free cash flow. Well, revenue is growing, but cash flow is not. If we also go here to the metrics, what is the cash flow margin doing? So yeah, right here we can see that in the first quarter of 2021, the free cash flow margin was 25%, and it's dropped now to 20%. So yeah, I would like to see this business grow its free cash flow before I start really taking a look at it again. I mean, revenue growth is nice to see. It's great. But as a cash flow investor, I want to see the revenue growth translate into actual cash flow and profit growth for shareholders. So yeah, if this stock was selling for about 20 to 22 times free cash flow, I would be much more interested in it, but I still think that it is selling at a slight premium for a business that is struggling to grow its cash flows with revenue. That's just my opinion, by the way. I have no idea if I'm right. That's just my opinion. All right. What do we got? Daniel, if you could do a longer video, analyze 3 companies. Okay. I'm trying to catch up here. Thoughts on PDD up close to 100% in the past 6 months, or generally Chinese stocks? So here's my thing with Chinese stocks. I was actually asked to talk about Chinese stocks today. My thing with Chinese stocks is, I mean, the Chinese government is a huge wild card. So there is risk with the Chinese government and with the world right now, almost going through like deglobalization, it seems like countries are kind of not wanting to work with each other as much anymore. So if that happens, then there could be increased conflict, increased tensions between China, the US, and the Western world, which probably wouldn't be good for the overall optics and business of Chinese companies. So there is risk there, like there's just a lot of, not a, well, I don't know how much risk. It's hard to quantify how much risk there is. Anyways, I do own Alibaba. I just think Alibaba is a very solid business for the long term. I really like the company and I see their future growth potential and I like the price. So I was buying more Alibaba below $100 a share. And yeah, I'm not going to go that big in it though, because as I said, the Chinese government is like a huge wild card. And I don't want to make Alibaba like 20% of my portfolio or anything like that. I want exposure to China because I see China's growth story. And I think Alibaba is one of the best businesses to own in China. But with that said, I'm going to limit that exposure. I believe it's about 3% of my portfolio now, and I'm just going to leave it at that. I don't want like massive, massive exposure to China because it makes me a little bit uncomfortable. So yeah, I'm comfortable, but I am comfortable with about 3%, if that makes sense. Anyways, this stock, PDD, is down with every other Chinese stock, about 66%. But from its lows here, as you said, it's up about 150%. Now, if we take a look at the financials of this business, revenue is growing. Revenue trend is going up. Okay. Does it have cash flow? It does have cash flow. And cash flow is at an all-time high. Cool. So if we go to our freeform tool, I wonder what the stock is selling for. Because most Chinese stocks are selling for very cheap valuations right now. So what is it selling for? I'm going to guess. It's up 150%. I think it's still going to be below 20. I'm going to say 15. 16.7. Okay, I was close. Yeah, I mean, that's what I mean is these Chinese stocks are selling for attractive price ratios. Like 16 isn't that expensive. Alibaba is selling for about 18. What's Alibaba's price to operating cash flow? And honestly, I don't know a lot about PDD. I'm kind of just talking about overall Chinese stocks right now. But Alibaba is selling for like 10 times operating cash flow. And this company is cash rich. So if we go to the enterprise value operating cash flow, I think it's like 7. No, sorry, it's 9. 9.3. So when you factor in the cash versus debt, this company is selling for like 10 times operating cash flow, which I think is very good. And I think that this business has a lot of future potential. So basically, my thoughts on China are, if you're okay with the risk of the Chinese government and you see the long-term growth potential of China and you see like the rise of China and the Asian economies, for me personally, I'm happy with that risk and I want exposure to that growth. So I have about 3% of my portfolio exposed to that growth. And I'm okay with that. But again, China is kind of a wild card. So you just got to be careful. Do what you're comfortable with. All right. Why have you avoided investing in Tesla up to this point? Any regrets? No, I have no regrets. Yeah, I mean, Tesla, the stock absolutely exploded and freaking took off. I mean, it was up 2,500% over the course of 2 years. But I think, okay, listen, I think Tesla is an awesome business, but it's way too expensive. It's way too speculative. And this straight up, this was a bubble. This was an electric vehicle bubble. It wasn't just Tesla. It was like Neo. It was, I don't even know these other companies like Lucid. every single electric vehicle company saw this kind of price action, and in my opinion, it was a speculative bubble. And Tesla is one of the companies where the speculative bubble, in my opinion, is still going on. I think it's just, I just think it's too expensive for me. And yeah, I mean, the stock is up over 2000%. And a lot of people may look at that with regret, but I don't regret missing Tesla because it was a stock where I thought there was a lot of risk. I thought it was very speculative. I thought the electric vehicle market is a bubble, still a bubble that needs to come down a little bit more. So basically what it comes down to is for me to have invested in Tesla, it would have basically been breaking all of my investing principles and all of my investing rules. And that would have made me incredibly uncomfortable. And I don't think, personally, I don't think that you can. How do I word this? This is why live streams are hard because it's hard to gather my thoughts. How do I say this appropriately? Okay, here's what I'll say. I think that a lot of people on Tesla, as crappy as this sounds, got kind of lucky because of the speculative bubble element. Like, again, Tesla is an awesome company. It's growing really quickly. But I think this company ran a lot harder than it should have relative to its underlying growth. And I think that this caused a lot of people to get kind of lucky on the stock. And I hate saying that because I don't know. It's really hard for me to explain my feelings on Tesla, to be honest with you. I just think it's too expensive. And I think that if you got lucky on Tesla, then it could have taught you a lot of very bad investment habits where you focus on revenue growth over everything. And then what would happen is I think a lot of people may take their profits here on Tesla, maybe, they make 20x on their investment. And what they learned from Tesla is that if a company's revenue is growing, then the stock is just going to explode. That's kind of what I think. I'm not 100% certain on that, but that's my feeling is I think Tesla could have taught some people who got lucky a lot of very bad investment strategies, I guess, that if they go and apply that to more investments in the future, it's probably not going to work out. So the main thing for me, and I'm sorry if I'm offending anyone, but the main thing for me is my investment process has to be repeatable for decades. So if someone got lucky on Tesla and they cannot, but they didn't develop a repeatable strategy that they can then go and use on the next investment and it will work, then again, I kind of just think that it could have spawned bad habits. So for me, no, I am not regretful that I missed Tesla because it did not fit my investment principles. And, you know, I'm going to miss some big winners like this. It is what it is. But my goal is not to hit every big winner. My goal is to be able to compound and create wealth for decades using a repeatable process that I feel comfortable with. So, yeah, I mean, it sucks that I missed Tesla. It sucks that I didn't make 20x my money. Honestly, though, like if I bought Tesla right here and the stock ran like 400% on me in a year, I probably would have sold it. I would have been like, this is nuts. And then you get this, and then you get another 200% run, and then it continues going. So who knows, man? That's just my thoughts. All right. Hello. Hello, everyone. We still have 40 viewers in here. We've been going over an hour. Oh my goodness. I'm sorry, guys. I'm sorry. Anyways, 77 Magic Bus. Let me know what you think about that answer. I did my best there. I'm sorry if it wasn't a great answer, but let me know what you think. Okay. Any thoughts on Dutch Bros? Oops. On Dutch Bros. Okay, so this stock IPO'd in 2021, it looks like. My coffee went cold. I'm enjoying talking too much. Okay. This company IPO'd in 2021. It's in the hotel and restaurants industry. Okay. So industry was probably having a hard time over the past couple of years. Let's take a look at the income statement quarterly. Weird. I wonder if this is a data bug. So when companies do IPOs, for some reason, we're having a little bit of data errors. We're working with our data provider on it, but just letting you guys know, IPOs and SPACs, you kind of see stuff like this on Stock Unlock once in a while. It sucks. We're really working hard to fix that. But anyways, it does look like over the past few quarters, this company has been growing its revenue. What about its cash flow? Okay, so trailing 12 months, it is operating cash flow positive. Love to see that. Free cash flow negative though. Okay, don't love to see that. What is the price? $6 billion for this business. What was the income? Okay. Sorry, my mind is kind of all over the place with the stock right now. Gross margin 26%, operating margin negative 22%. What are insiders doing? Right on. Insiders selling all over the place. Love it. Operating officer, operating officer, operating officer, operating officer selling about $1 million worth of shares. This large company sold a lot of shares. Holy smokes. More insider selling, exercise, insider buying right here. Okay. Independent director in May bought about 150,000 worth. So lots of insider selling going on with this business. Now, based on the numbers I just was I even taking a look at the right stock? Yes, sorry. I'm going to close this tab. I don't know what's going on. Okay. So gross margin is not incredible. Take a look at the insights really quick. Yeah, so profitability on this business is not very good. Gross margin's okay. Operating margin, net margin, free cash flow margin, all negative. Lost $126 million. Okay. Financial health, current ratio is 0.5. Okay. What is the price? I'm going to guess that this business is priced very high because it's got a $6 billion market cap. And it's not making any free cash flow, so we would have to use the operating cash flow. You guys see that? 144 times operating cash flow. What's the price to gross profit? Next. I'm sorry. Not a stock I would buy personally. I think it's too expensive. Yeah, the revenue's growing. It's got operating cash flow. It's not free cash flow positive. Balance sheet doesn't look the best. And that price is way too high. 140 times operating cash flow. What was that? 36 times gross profits. I think it's too expensive. Like that right there. I don't want to look further. I just think it's too expensive. Agree with your answer. I think I got lucky on it and sold it. Sold a third. This is a Magic Bus replying to me about Tesla. I'll restart. I agree with your answer. I think I got lucky on it. Sold a third of it after making 12x. Nice. Holy man. Keeping the rest for the long term and expect to buy more as the price comes more in line with reality of a recession. So, I mean, I think you're being incredibly mature, saying that you got lucky on it. And honestly, I agree. I think a lot of people got lucky on Tesla. Here's the thing. I don't want that to discount the incredible due diligence that people put in on Tesla because a lot of people were very right on Tesla. Okay. So when I say that people got lucky, I think a lot of people got lucky, but the people that were buying Tesla when no one wanted it in like 2019, those people I have massive respect for. But the people that bought Tesla when it was already up like 500% and then just ran and continued going up on them, I think those are the people that got lucky, if that makes sense. So yeah, 12x in 2 years. Like, congratulations to you. That is an incredible, incredible return. Amazing. Yeah, I mean, you sound like you're very mature. You know what's happening. You're invested for the long term in the rest of it, and you're going to buy more if the price comes down. Listen, I would love to own Tesla with you if the price comes down to reality, as you said. I would love to, but I just can't. I would feel way too uncomfortable buying, and I would get emotional if I bought it right now because I would buy it and then it would go down 30%. And I'd be like, I made a mistake. And then I would probably make another mistake and sell it. So, yeah, that's my thoughts. I agree that EV stocks are still in a bubble. Tesla is 2 times beta to S&P. So plenty of room to fall hard in a recession. I agree. I mean, I think Like Neo, for example, I still think that Neo is very expensive. There was this one electric vehicle stock right here, Solo. Take a look at this. This is what I mean. This stock in 2020 was worth $1. And then the electric vehicle sector ran so hard that even this stock that makes no money ran at 970%. That to me is a speculative bubble. And that's why I think that Tesla also had a lot of speculation in it because the entire electric vehicle market was seeing price action like this. So, I mean, this stock is down almost 90% now. And yeah, man, I just think that it was a really big bubble. I mean, take a look at this. This company's revenue in the trailing 12 months, it did $3 million in revenue. Okay. Revenue. And at the peak there, it was like a $2 billion company. So a $2 billion company doing $2 million in revenue, that's like 1,000 times revenue. It was insane what we witnessed in 2021. It was truly insane. Um, yeah, fair enough. If you're in your 60s, you do have to factor in a lot more time. Like I'm young, so if I buy a stock, I have the luxury of being able to hold it for 40 years, hopefully. Hopefully, you know. So yeah, when you do get older and you're getting closer to retirement, you got to think about your risk, your timeline, and yeah, because if you have this massive nest egg when you're about to hit retirement, do you want to risk it on a stock like a Neo when you have to rely on that money in like the next 5, 6 years? Yeah, it's incredibly risky. Can you please look into MCB Bank? VJ. Yeah, of course. MCB, Metropolitan Bank Holdings. Oh, it's a smaller cap company. Interesting. Okay. $793 million is the market cap. Cool. IPO'd in 2017, it looks like, fell in 2020, is way up. What is it up? It's up 200% still. Nice. Okay. Cool, cool, cool. Earnings yield 10%. Forward price to earnings ratio 7.2. 10 PE. Cool, cool, cool. 4.63 insight score. Let's take a look. Bank specific metrics 4.7. Awesome. Okay. Deposits increasing 17% year over year. Very good. Interest income 37%. Very good. Non interest income 80%. Loans increasing by 27%. Tangible book value per share 21%. Return on tangible equity 13.7%. And efficiency ratio 0.46%. Dang, dude. What? That's really good. That's really good. Hold up. I'm sorry. I'm getting off topic here. We got to compare this to Equitable Bank. Okay. Growth. More growth than EQB. Oh no. Oh no. What have I just stumbled into? Higher bank specific metrics in EQB because their non-interest income is increasing by 80% versus negative 30%. Financial health intangibles. Shares increasing by 20% though. So my question, boom, there's my question. This company's growth is really good, okay? I mean, 80% non-interest income growth. These are like double-digit growth rates for a bank on all metrics. But then you have the shares increasing by 20%. So strong growth, lots of shares increasing. To me, this looks like an acquisition. It looks like this company did a large acquisition, which fueled a ton of growth, but it diluted a lot. So, but is that right? Is that right? Let's see. It's consistent revenue growth. What happened with the shares though? Okay, so the shares increased massively right here. I'm going to guess that this was an acquisition. So then my question becomes, what quarter was that? That was the fourth quarter of 2021. So what happened to the revenue in the fourth quarter of 2021? It saw a boost of about 20% in that quarter. Okay, what happened to the net income? Saw a boost of about 10%, and now it's really growing. Okay, assets. Did assets grow? Assets did grow. Liabilities, book value, tangible book value. Tangible book value spiked here as well. So I don't exactly know what's going on here with this business. I'm going to speculate that they did an acquisition, which is fueling a lot of growth. I do like this growth, though. I really like this growth. Does it pay a dividend? It does not pay a dividend. Does it buy back shares? Looks like it might buy back shares. Does not look like it's buying back shares. Okay. Price to earnings. Let's go. So when this company IPO'd, its price to earnings ratio was very high. We don't have a lot of historical data because it IPO'd recently. So we can see that back here, it was trading for a price to earnings ratio of 13.7. Now it's trading for a price to earnings ratio of 10. Its average over the past 3 years is 11.7. So it's selling below its historical average price to earnings ratio, and it's selling below where it was at the end of 2020. If we take a look at the revenue has grown at 37% since 2019. What is the revenue per share doing, though? Revenue per share has grown at 24%. So even though this company diluted, its revenue per share is still growing very well. What is its EPS doing? Even though it diluted, its EPS is still growing at 27% over the past few years. Listen, this is interesting. This is actually an interesting company. I like that it's a small cap too, because I am comfortable with small caps. It's in the banking sector, and the entire banking sector has seen a really big correction over the past year. So it's not just this stock. I mean, even if you take a look at JP Morgan, and this is because everyone thinks we're heading into this massive recession, right? So typically in recessions, bank stocks don't do very well. I mean, even JP Morgan is down 34%. So in my opinion, just my opinion, not a financial advisor, I think banks look attractive right now. I'm going to go off topic a little bit, but one bank stock that I've also been adding is Royal Bank of Canada, because it's seeing the same thing. It saw this big correction. It's down like 18%. And I've been using this correction to buy more shares because I think banks are super solid still. I mean, they're reporting earnings. Earnings still look great. Revenue is growing. Everything is fine. And the market is discounting banks right now. So I do think I think the banking sector, the financial sector, and the real estate sector right now have opportunities in them. Like I'm dollar cost averaging Dream right now. I'm dollar cost averaging EQB. I'm dollar cost averaging TD Bank and Royal Bank, because I think that's where a lot of value is in the market right now. And this stock looks attractive. Based on everything we just looked at really quickly, I do think MCB is a research candidate. I'm going to add this to my watch list. I'm going to add it to cheap stocks, and I'm going to do more digging. Based on everything I just saw, it does look attractive. I just want to do more digging into like the management and everything, and take a little bit of a deeper look. But thank you for bringing this up. Thank you. Nice little pick here. Really nice. All right. Your stocks for retirement, Daniel. Google. For me, Google. Also, Canadian banks. Royal Bank of Canada, I think, is a great stock for retirement. TD Bank. TELUS. Capital Power. Man. Oh my goodness. Capital Power. Also, Equitable Bank. What am I doing? I can't type. Oh my goodness. CPX.to. I really like this stock. This is a utility company. It's got a very nice dividend. It's growing the dividend at 5 to 6% a year. And while the overall market has been down, CPX has ran 36%. It's naturally grown its way to one of my largest positions in my portfolio. And it's just like massively outperformed the S&P 500. It's a utility company. Really boring. No one ever wants to talk about it on my channel. Every time I make a video about the stock, no one wants to hear it, which is fine. I get it. But look at that. Ridiculous. Also, another company that I have in my retirement portfolio is Empire. This is a grocery stock. If you're Canadian, they own Safeway, they own Sobeys. So, thesis here, as long as people need to continue buying groceries, this stock is going to make money, or this company is going to make money. And people got to buy groceries. So, I think this company has a really long-term, let me change my words here. My retirement portfolio is built of companies that I think are going to be in business for the next 40 years. Empire, I think, is going to be in business for the next 40 years because people are going to be buying groceries for the next 40 years, hopefully, unless something major happens. And then in that point, I'm probably not going to be investing in the stock market. Capital Power, this is an electric utility company. People are going to have they're going to be paying electricity bills forever. And with the world moving more towards renewable energy and electricity, I mean, more of our fuel that powers our economy is going to be electric. So Capital Power is an electric utility company. So I think that they stand to benefit massively from our transition to a more electric economy. So I think this company has massive tailwinds behind it for decades to come. I mean, we got to talk about CNR. It's a railroad. I think that railroad companies have like the largest moat I can ever think of, especially in Canada. And this is a railroad company, right? Super boring. No one ever wants to talk about railroads. Again, it's fine. I get it. But take a look at this. Since 2002, this railroad stock is up about 2,600%. If you want to take a look at the dividend, this company grows its dividends basically every year. And your historical yield on cost for the stock, if you bought it in the year 2000, is now 48%. So if you bought the stock in 2000, you're now getting a 48% return on your investment every year in cash through the form of a dividend. And this is what I really like for my retirement portfolios because I think Canadian National Railroad is going to be in business for the next 100 years. And over that time, they're going to continue increasing their dividend just like they have over the past, 20 years. And yeah, so I think as I hold this stock, the dividend is going to continue growing over the long term. My dividend yield on cost is going to continue growing. My dividend income is going to continue growing. And I just don't think that this stock over the next 50 years is going to lose money. I think that it would be very challenging for the stock to lose money over the next 50 years. So, in my retirement portfolio, I really like dividend paying stocks because in my RRSP, I'm not taxed on dividends. So I get that those dividends for free essentially. I use that money to reinvest into my dividend portfolio. And I want these stocks that I think are going to be around for literally the next 50 years. So that's my strategy in my retirement portfolio. And that's what it's full of. That's really what it's full of. It's just like really solid dividend paying stocks that I think are going to be around for basically ever, hopefully longer than me. So that's kind of my thoughts. Isn't CPX highly priced for utility, high price to earnings ratio? I don't know if you were here earlier on in the video or in the live stream, but I don't really love earnings. I don't love the earnings metric. I mean, yeah, when you take a look at the stock's price to earnings ratio, it's ridiculously high, right? Let's go and take a look at cpx.to in the freeform tool. Let's take a look at its price to earnings. So this is what I mean. Take a look at this company's price to earnings over the past decade. Like it's been 47, 48, and then it drops to 0, and then it goes up to 20, and then it goes up to 43, and then it drops to 17, and then it drops to 10, and then it goes to 31. And you can see that it's like incredibly volatile. This is what earnings do. Earnings are just super volatile for most companies. And that's why, like, when I'm valuing a company and I see this to me doesn't look very reliable. So for a company like Capital Power, instead, if you take a look at the price to operating cash flow, look at how much nicer this chart is versus the price to earnings. Like when you take a look at this chart right here, let's zoom in. When you take a look at this chart right here, which one looks more consistent? Which one looks more predictable and dependable? The price to earnings or the price to operating cash flow? So for me, I like the price to operating cash flow metric for utility companies, and it's my favorite metric for utility companies. So over the past decade, I'm going to zoom back out. But right now, this company is selling for a price to operating cash flow of about 5.6. Over the past decade, its average has been about 5.3. So right now, in terms of operating cash flow, it is selling at about a 5% premium. So it's not the cheapest stock out there. I'm just holding it, but it's not the cheapest stock out there. But if the stock gets down to, like a 5 price to operating cash flow or like a 4.4, then it will be selling below its historical average. Also, the dividend yield will be above 5% at that point, and the dividend per share is growing very nicely. Take a look right here. The dividend per share since about 2015 has grown at a compounded annual growth rate of 7%. So every year they're increasing their dividend payment. And if it's selling for a 5 price to operating cash flow, then it's also got about a 5% dividend that will grow at 7% ish. So I think that is a very good dividend income stock, and that's why I don't really pay attention to price to earnings too much. On in the financial sector, I really pay attention to price to earnings because cash flows. I mean, take a look at JP Morgan. Oh, dang it. Take a look at JP Morgan's free cash flow, okay? Over time. Look at that. Right here, free cash flow 26 billion in 2008, negative 110 billion in 2009, 123 billion, and then a few years later, negative 27 billion. And then a few years later, $110 billion in free cash flow. This is ridiculous. Banks, you cannot use free cash flow. It just doesn't work. Like, take a look at JP Morgan's price, free cash flow. I mean, right here, it was all the way up at 250. Then it drops down to 4. Then it goes back up to 12. Then it goes to 0. Now, take a look at price to earnings. We're going to zoom into the past 10 years. This is much more reliable and much more consistent. You can see that it tops out at about 16 and it bottoms out at around 8. So JP Morgan trades in the price ratios in the terms of price to earnings from 8 to 16 historically. That's much more consistent than price to free cash flow, which trades anywhere from 252 and 0. And this is for all financial stocks. So for financials, I always use price to earnings. And then for basically every other company, I try to use free cash flow. But a lot of companies have high capex spend. And when companies have high capex spend, then I use operating cash flow. It's kind of weird. But yeah, it's kind of the system I've developed. Yeah, so price to free cash flow. Someone just asked me about price to free cash flow. So if we go to cpx.to, oh man, I got to stop doing that. Just search it in the freeform tool, Daniel. What are you doing? Okay, price to free cash flow. Oops, free cash flow. So if you take a look at price to free cash flow for CPX, it's kind of like JP Morgan, right? I mean, their price to free cash flow got up to 1,400 right here. Now it's selling for about 12.6, but you can see that the price to free cash flow is very volatile. And this is because the company goes through periods of very high capex spending. It's a utility company, so sometimes it spends a lot of money on like developing a new power plant or something like that. And then when it is developing that new power plant, it has these very high capex expenditures, which affect free cash flow massively. So that's why you see free cash flow go kind of all over the place, like negative 446 to 219 million, back down to negative 71 million. It just depends on where the company is in its capex cycle. So instead, I like to focus on the company's operating cash flow, which removes the capex and just shows you how much the actual operations of the business are producing. And that to me kind of gives you a better indication for utility companies on how much cash can that business return to you. The question I'm always trying to answer is how much cash can this business give back to me? How much cash can I get back out of this company or the stock? And for utilities, a lot of the time, I think that the best metric there is operating cash flow. And it seems to be the most consistent metric across all utilities. It's just price to operating cash flow. You can see how nice this chart is. So that's what I use. That's how I value these companies, and that's how I think about them. Sasha Yanshin saying dividend investing sucks. You should watch it and react. I don't like drama, okay? No. He can have, I'm gonna, I don't know who they are. I'm gonna say they, not he. They can have their opinion on dividend investing. That's fine. And, there's no one size fits all for investing. So my opinion is dividend investing is awesome because you can get situations like this. I'm not going to do that. We're going to go to this tab. I'm learning. So let me show you. For example, let's go back to CNR. This company pays a dividend and it increases its dividend every single year. So back in 2002, you would have a 48% dividend yield on cost. So if you were buying this stock in 2002 and you held it for the next 22 years, you're now getting a near 50% return on your initial investment every single year in dividends. That's incredible, especially if you're someone who wants, like one of my goals is to have my portfolio be able to pay my bills through dividends. Like I would absolutely love to make like $30,000 a year in dividends, and my mortgage is covered, my utilities are covered, my car insurance is covered, my gas is covered. I'd probably even still have a little bit of cash left over. And that's the most passive form of income that I can possibly think of is dividends. You don't have to do anything. You just have to hold a stock in your portfolio. Boom, income coming in. That's great. I love that. So, I mean, again, it just depends on what kind of investor you are. I understand the argument if someone says, well, dividends take away from growth. I get it. But it just depends on what your goals are in your portfolio. And for me, one of my goals is to have my dividends pay for my um, retirement, essentially. So I love dividend investing. DLB, DL, DLB. Sorry, I'm getting distracted. You talked about CNR, but what about CP? I think CP is a great company too. The company is not as focused on paying dividends as CNR. Let me show you. So if we go to CNR's financials right here, and we go to cash flow, you can see that CNR in the trailing 12 months, CNR in the trailing 12 months has generated $6.8 billion in operating cash flow. Okay, so we got 6.8 billion right here in operating cash flow. And if we go down, we can see that, okay, well, CNR has repurchased a lot of stock in the past year. CNR, you're ruining my example. Okay, so right here in 2020, this is a good example. So right here, we can see that CNR paid $1.6 billion out in dividends, and the company repurchased only $346 million worth of shares. So you got $6.8 billion in operating cash flow, and 1.6 of that, I don't know why my calculator's up. I don't know what I'm doing. But $1.6 billion of the operating cash flow went to paying dividends, and then $346 million went to buying back shares. So you can see that CNR historically likes to spend more of their cash flow on paying dividends. So in my opinion, I think CNR is a better dividend income stock. And if we go and take a look at CP, CP generated about $3.7 billion in operating cash flow and in the past year. And oh, man, these companies are not really making this a good example for me right here. In 2021, I don't know what happened. These companies flipped roles. But anyways, historically, take a look at this. So in 2020, CP made $2.8 billion in operating cash flow. I'm collecting my thoughts now. Sorry, everyone. $2.8 billion in operating cash flow. And you can see that $467 million of that went to paying the dividend. So that's like 1/7 of the company's operating cash flow went to paying a dividend. And then the company spent 1.5 billion on buying back shares. So historically, CP spends a lot more money on buying back shares than they do on paying a dividend, whereas CNR historically spends a lot more money on paying a dividend than buying back shares. So, in my opinion, I think CP is a fantastic company, but I think that it's more focused on share price appreciation and buying back shares than paying a dividend. So, in my opinion, I think CP is a better growth stock than CNR, but I think CNR is a better dividend income stock. So, again, it really comes down to what is your preference. Are you an income investor? Do you care about dividends, or do you care about share price growth? If you care about share price growth, CP is probably a better fit because, again, the company's focused on buying back shares, not paying a dividend, whereas CNR is focused on paying a dividend, not buying back shares. So, yeah, that's my opinion. I think both companies are fantastic. And yeah, that's just what I think about them. Okay. There is no promotional code available for Stock Unlock. Yeah, we don't have any promotional codes. I mean, our goal here on Stock Unlock is to make this platform as affordable as possible for all of you. I mean, our competitors are usually charging $15 to $30 a month for their research and analysis platforms. We charge $7. So we price ourselves very affordably for our users, and we do that on purpose. We really want this to just be like the best platform for everyone. And we really care about our users' cash flow, and we don't want to like gouge our users. So we are actively pricing stock unlock low. And we are consciously doing that because we care about you guys. We really care about our users. And I'm a paying member, okay? I don't get stock unlock for free. I pay for it. And I'm a founder. I've created this platform and I pay for it. So I try to put myself in the user's shoes. Like, I'm actually paying for this platform too. I want to be in there with you guys and like, am I getting my money's worth? How can I get more money's worth? And that's how I think. I am a user. I use this platform every single day. So right now, there's no promotional codes. You can get a 2-week free trial though, if you just enter in your email, and you can come and check it out. But yeah, right now we don't have any promotional codes. Okay, sorry, I'm just reading comments. I just went blank there for a second. It's no drama, just a really good video idea. He's cool. If the guy's cool, I'm assuming it's a guy again. I don't know if it's a guy. If they're cool, then maybe. Yeah. I don't like drama. I avoid drama like the plague. Life's too short for drama. So that's why on my YouTube channel, if someone calls me out, I'm just like, I don't care. I really don't care. I don't engage with it. So yeah, if they're cool and I can make a good video, then potentially I will. I'll take a look at it. Sasha Yanshin. I'll take a look and see what happens. Thank you, Sophie, for the great answer on dividend investing being a type of investment. All very good points. Yeah, it just depends, I think like when you're investing, you should always be asking yourself, like, what is your goal? Like, what is your goal in your portfolio? If you're like a dividend investor and you want income in your portfolio and you're buying like Google, I mean, I think Google's a great company. I own it, but it's probably not going to fulfill your goals in your portfolio. So yeah, I mean, I think it's just a good idea for all investors to take a minute, probably more than a minute, and just really think about like, what do you want from your portfolio? What is your goal? And then you can start really finding investments that meet the goals in your portfolio, and like investing becomes really exciting when you do that. Okay. Stock unlock. How is your diversification in your portfolio? I'm lacking industrials. Got any ideas? Industrials. My diversification. My diversification is interesting. I mean, the answer of diversification also comes down to you as an investor. I mean, Charlie Munger, for example, owns 3 stocks and he's happy. Like, he has no stress just holding 3 stocks. Whereas if I held 3 stocks, I would not be able to sleep at night. So, I mean, whenever I answer the question of diversification, it worries me because it almost makes like, I don't want someone to copy my diversification, because what I'm doing in my portfolio works for me. I'm comfortable with it, but it might not work for you, and it probably will not work for you. So the best diversification, in my opinion, is what you're comfortable with. Like, for example, I don't think everyone needs to own oil. I don't own oil in my portfolio. And, someone may look at that and be like, oh, well, you're not diversified in oil. And I'm like, I don't get oil. I don't know what's going to happen with oil. Okay. I don't know. So I don't want it in my portfolio. Whereas utilities, I really understand utilities because, people need electricity, people need water. So I really understand utilities. I really understand railroads. I really understand banks. So I feel more confident just investing in those. So yeah, I hope that answers your question. Yeah. What's a good railroad for us in the US? Berkshire Hathaway owns a railroad. I think they own like I actually don't know what they own, but UNP. UNP is an interesting railroad stock in the United States. They've also seen ridiculous growth over the past like 20 years. Not quite as much as CNR actually. They're up about 1,500%. This is a really nice railroad. The one thing you have to know about this company, though, I'm going to show you, hopefully, because I was taking a look at the stock. And what I noticed is, okay, take a look at this. In the trailing 12 months, they produced roughly $9 billion in operating cash flow. Okay, so they have $9 billion coming into the businesses. Sorry, they're producing $9 billion from the business's operations. Then I ask myself, where is that money going? Okay, 3.4 billion goes to CapEx. So they have $9 billion in operating cash flow minus $3.4 billion in capital expenditures. So they got about $5.6 billion in cash flow, okay, in free cash flow. I don't know what I'm doing. So this is how much money the business has in free cash flow, right? Then they paid out $3 billion in dividends in the trailing 12 months. So if we subtract $3 billion in dividend payments, this leaves the company with $2.6 billion left, okay? So how did they, if they have $2.6 billion in free cash flow after paying the dividends, then how did they spend $6.3 billion on buying back shares? Math doesn't add up. So they spent $3 billion on dividends plus $6.3 billion in share buybacks. So they spent $9.3 billion on returning cash to shareholders, but their business, even in operations, only produced $9 billion. So how are they doing that? Well, interesting question. The company is taking on debt to buy back shares. That's how they're spending so much money on buying back shares. I don't love that. So UNP, I think it's a great company. I think it's got a huge moat, but I don't love that the company's taking on debt, essentially leveraging up the balance sheet to buy back shares. That's what they're doing. That's how they're affording to do that. Yeah, I don't love it. So a great railroad stock in the US. I actually don't have one off the top of my head. I wouldn't buy UNP just for what they're doing. I really don't like that they're taking on debt to buy back shares. Okay, what's going on? All right, next questions. Besides the dividend score, is there any other features, aspects that Stock Unlock has for dividend investors? Besides the dividend score, we just made this new dividends tab right here, and we're going to be adding more dividend features. We're actually building out a portfolio tracker right now, and I'm going to do something. Don't tell my co-founders. Jake and Nick, look away. Look away. Do 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 do. This is gonna be worth it, you guys. I promise. I promise. Okay, it's gonna be worth it. I'm showing you guys something that you should not be able to see yet, but I'm gonna show you. Okay, this looks nice. Okay, I'm gonna go like this. I'm taking a screenshot of my screen now, and I'm gonna save this. And then I'm going to open it over on my other screen. And I'm going to show you guys what we're working on. Okay, this right here. So we're building out a portfolio tracker on Stock Unlock. And this is a screenshot, so I'm sorry for the low quality. But we're building a dividends page in the portfolio tracker. And it's going to look something like this. So this is the design that I've come up with. And so it's going to show you like your portfolio, how much of the stocks in your portfolio are dividend paying stocks. So like if you own 75% of your portfolio does not pay dividends, this pie chart right here will show you that. And then it will show you, okay, 25% of your portfolio is paying dividends. Then it will show you your total dividends income, yearly income, monthly income, weekly income, daily income, and hourly income from your dividend portfolio. It'll break down all of your dividend income by stock, your projected income over the next year with your dividend income goal in the same chart, so you can like see how you're building towards your goal. Then a table of all your dividend income right here. This will be a sectors breakdown. This is going to change. It's going to be like a pie chart with a bar chart beside it. But then also your countries breakdown. So we'll show you where your dividend income is coming from around the world. It will show you a world map right here, and basically just show you like what countries are paying your dividends, what sectors are paying your dividends, what businesses are paying you dividends, like how much all of that is. And yeah, this is just the beginning, you guys. This is going to be in our portfolio tracker that we're working very, very hard on. So we have a lot of things coming for dividend investors. And yeah, just stay tuned. Other than that, we just created this dividends tab right here that shows you the company's historical dividend yields, dividend per share, payout ratios, free cash flow payout ratios, ex-dividend date, historical yield on cost. So you can see right here, for example, that UNP. If you bought the stock in 2000, you now got a 50% yield on cost, which is awesome. historical dividend growth, and the dividend payments. So that's like our dividends tab right now. We're going to add more to this tab as well. What I really want, like for a company like CNR, for example, what I want is to take the cash flows and then have a pie chart that's like, this company pays out 54% of its cash flow as dividend, and then it would show the other 46% goes to share buybacks. So you could clearly see, okay, this company does pay a dividend, but maybe it's not as focused on paying the dividend as it is on buying back shares. Like CP, for example, that pie chart would show you, um, you know, 1/7 of the cash flow goes to paying a dividend, and then the rest of the cash flow actually goes to buying back shares. So then you, as the investor, can look at that one pie chart and be like, okay, this company is more focused on buying back shares. If I'm a dividend investor, maybe that's not something that I want. So we're going to make this tab a lot better. Like, things just take time. It sucks that things take so long. But we work every single freaking day on this platform. It's almost insane. But I love it. We love it. We really have a passion for this. So we're going to make the best platform. It's just going to continue getting better. Do you think you could add a screening option for the insight score? Yes. After the portfolio tracker, we're building insights screening. So that's like the next two major features. We're going to like sprinkle in features all over the place, like smaller features. But the next major feature is portfolios and portfolio tracking. And then we will add in a insights screener. And hopefully that will be done by like November, both of those features. I believe I'm going to start testing the portfolios. Like, I can start testing the portfolios right here on my account because I'm special. But yeah, so like you can test the portfolios right now, but everyone else doesn't have access to this yet. And hopefully we can start testing these with our beta testers very soon. And then we'll build the insight screener to answer your question. You can buy Berkshire for railroad exposure. I agree. Yep, you can. Lincoln, yeah, that was a sneak peek right here of our, I don't know what just happened. But yeah, that was a sneak peek of our dividends portfolio tracker that we're building. Are you a developer, designer, and are your co-founder build your designs? Yeah, so I don't have any schooling with like anything. I graduated high school. That's it. I never went to university, and I just love investing. Like, I don't know why. It was like my brain was built for numbers and investing. So this is just what I've landed on through just like my years of, working and running businesses. I've owned multiple businesses, and yeah, this is just what I've landed on. And what was the question? Are you a developer or designer? I am not a developer. I have no coding experience. I'm pretty bad at it. And I am not a designer by like trade or anything, but Stock Unlock is my design. I am the one who works, we contract out as a designing company, and I am the one who works with the designing company. So the design that you see here on Stock Unlock, like the insights, the financials, the dividends tab, analyst tab, everything here is me working with a designing company and like every day giving them feedback and basically coming to a place that I'm happy with. So for example, like this design right here of our dividends portfolio information, every feature here is a feature that I've researched and basically said, yes, I think this is valuable. I want to put it in this page, our dividend portfolio page. And then I collect all the features that I want. I kind of rank them from where I think that they'll make the most sense. And then I basically make like a spec doc, and then I send that out to our designers. And then the designers work with me to basically build the page and put everything where I want it. So for example, right now, our sectors breakdown, like this is how it is right now, but I don't like this. This is a design we got back from our designers. I hope my co-founders are okay with me talking about this, man. Jake and Nick, look away. Don't listen. Anyways, the sector breakdown, like right now, this is what we got back from our designers, but I don't like this view. So we're going to change the view of the sector breakdown, but basically everything else here looks good. And we're going to be adding more features over time, but just as the initial release, hopefully we can have all of this in our dividends tab. But yeah, that's basically how the flow goes on how we build. Um, is it going to be an app or a website? So right now, Stock Unlock is a website. We do not have an app, but you can use the platform on your phone. We're probably going to look into building an app in 2023. It's just building an app takes a long time and it costs a lot of money. And right now, with the way the world is, I think that being a little bit more on the conservative end with cash is a good idea. Yes, we could spend, the couple $100,000 on building an app, which would suck. It would be a lot of cash, but we could do it. But that would increase the risk of our financial situation. So, like when you're running a company and building Stock Unlock, for example, money equals life. And if you run out of money, it's not a good thing. So, just with the way the world is, with the way the economy is, with the uncertainty, we've kind of made the executive decision that we're just going to be really, really conservative with cash and just kind of save it as much as we can right now. Like, put out new features and build the platform every single day. We literally build this platform every single day, but not spend like, a couple $100,000 on an app right now. I just don't think it would be wise. And I really don't want to see Stock Unlock go under and fail. One of my biggest fears, actually. So, yeah, you just got to be conservative with cash as a business owner and know the times you're in. So, yeah, we'll probably build an app, but right now I just don't think that it would be like the wisest financial decision for us. We have a few other really big features that people want to, like portfolio tracking and a screener. So, we're going to build those first. I didn't see stock screener feature and stock unlock. Is that in the roadmap? Yeah. So after portfolio tracking, screener will be next. And as I said, we're hoping to get that out by the end of this year, hopefully by the end of November. Don't hold me to that. Every time I give a timeline, I get flack from my co-founders. They're always like, Daniel, you can't give in timelines, blah, blah, blah. So Jake and Nick, look away. Don't watch this video, but I'm hoping it can be by the end of November. All right. You don't need school. You have done well at it, and it's what you wanted. Investing is more practical. I agree. I think the world is moving more away from school. I don't think you necessarily need it. Yeah, that's just kind of my opinion. With that said, if you want to be a doctor, go to school. If you want to be an engineer, please go to school. I don't want to be driving across a bridge and have it fail on me. Okay. So I think for some things you should go to school. And I don't hate school. I think my girlfriend's in school. She's about to graduate as a physio. God bless her. The work that she's put in is incredible. Like she is so damn smart. I could not do what she's doing. God bless that girl. When we can maybe expect the tracker, as I just said, hopefully around November, end of November. Lincoln, do you ever meet up with other value investors or part of a value investing group? I should just stop sharing my screen. Why am I still sharing my screen? I don't actually meet up with any other investors, and I'm not part of a value investing in group. I think that would be cool. I've tried to, meet up with other value investors in my city, and there's just not a lot going on in the investing space that I've been able to find. And yeah, maybe I should do that. We'll see. Maybe I'll change that in the future. Maybe we can do a meetup one day. Sophie says, I love the design so far and can't wait to try it out. Yeah, thank you. It's going to be great. We're building a lot of great things here. Like, seriously, there's a lot coming. I think I've caught up on all of the comments, though. So we've also been live streaming for 2 hours now. Wow. Okay. So, yeah, I think if there's no other questions, if you guys have any more questions, just let me know right now. But other than that, I mean, we've been going for 2 hours. I should probably stop. Dividend investors, Andre Jick, dividend investors. I'm going to hold my tongue. I don't like drama. I'm not going to say anything. Okay. Here's a group I'm in. We meet via Zoom once a month. Cool. Index fund question. Okay. Index fund. I'm sorry I missed it. Where is it? I actually can't find your index. Oh, wait. You don't talk much about index funds as a core of a portfolio. It seems sensible thing. And then use individual stocks to create alpha. Okay, fair enough. Here's my thing, though. Here's my thing. So let's go and take a look at the SPY ETF. I need to share my screen again. Can you guys tell that I'm new at live streaming? Screen one. Share. Boom. We're back. Is this the view I want? I want this view. This view's better, I think. Yeah. Okay. So this is the SPY ETF here. And let's take a look at some of the top positions. All right. We got Apple with 7% of the ETF, Microsoft, 6% of the ETF. So between Apple and Microsoft, you have 13% of the ETF. Amazon, 3%. So 16% of the total ETF. Tesla, 2.2%. Google, in total, is about 4%. Berkshire Hathaway, and then even Nvidia makes up 1% of the ETF. Okay. But basically, what I'm saying here is in your top 4 positions of this ETF, you got Apple, Microsoft, and Tesla. Now, if we go to Apple, we're going to go to Apple in the freeform tool. Oops. This is why I right now don't own ETFs. I'm going to show you exactly why. My internet is slow when I'm live streaming, I've learned. Anyways, we're going to go to Apple's price to free cash flow over the past decade. So right here, we can see that Apple is trading for a price to free cash flow of 23 right now. Its average over the past decade has been 16, so it's selling well above average right now. And the price to free cash flow has grown at a compounded annual growth rate of 8.5%. What this means is that 8.5% of Apple's annual growth to the stock price has come not from the fundamentals of the business growing, but from the price that investors are willing to pay for that business growing. Now, don't get me wrong, Apple has grown its free cash flow over the past decade at a compounded annual growth rate of 9.21%. The company's also buying back a ton of shares, which makes the free cash flow per share grow at a faster rate. You can see right here the free cash flow per share has grown at 14.6% versus the free cash flow growing at 9%. This is because, again, Apple is buying back shares, which increases the per share value. Now, despite that, the price to free cash flow has still grown at a compounded annual growth rate of 8.5%. And this company is 7% of the SPY. It's also trading at a premium relative to its historical averages. So basically what I'm saying here is 7% of the SPY ETF right now, I think, is overvalued. I would not be comfortable buying it. And a lot of the SPY's returns over the past decade have come from price ratio expansion. Not so much, well, a lot of it has come from underlying fundamental growth, but a lot of the SPY's returns over the past decade have come from price expansion. What that means is for the SPY to continue growing at the same rates as it has over the past decade, its price ratios would have to continue expanding. Take a look at Microsoft here. Microsoft in 2012 was selling for a price to free cash flow of 8.5. Today, it is selling for a price to free cash flow of 30, and this stock makes up 6% of the SPY ETF. So essentially, over the past decade, Microsoft stock price has grown at 13% compounded annually just from the price to free cash flow expanding. So over the next decade, if Microsoft is going to return these same returns to investors, its price to free cash flow is going to have to expand at 13% annually over the next decade, which will cause this stock to trade at like a 70 price to free cash flow, which is ridiculous. So basically what I think is the SPY in index investing is a great option for long-term investors who just want to like put your portfolio on autopilot, but I can't do that. I've owned the SPY and I've sold it because I took a look at what was actually in the SPY, like Microsoft, Apple, Tesla, Nvidia, and I was like, I think these stocks are very overvalued, and I don't think these stocks are going to provide the same returns as they have over the past decade over the next decade. So for me, as like someone who thoroughly enjoys researching stocks and businesses and investing, I think that I can just get more returns by not owning the SPY over the next decade just because of where the SPY is today. I'm not trying to time the market or anything like that. I just take a look at what the SPY is actually made of, and I'm not super comfortable with it. And I'm not confident that it's going to give strong returns over the next 5 and 10 years. Like, I think Equitable Bank is going to outperform the SPY over the next 10 years or the next 5 years. So I would rather own Equitable Bank, just as an example. So yeah, favorite ETF. I actually don't have a favorite ETF. Probably the SPY. Even though I kind of just talked trash about the SPY, probably the SPY. Favorite ETF. What would be a better investment, POW or MFC? I own MFC. Yeah, I own MFC. I'm going to continue the live stream, but I got to run to the washroom really quick, you guys. It's been 2 hours, so I'm going to be right back really quick. Okay, I'm back. All right. You own MFC as well. Oh my goodness. Some comments came in. Okay, I got to stay on topic here because I'm losing my train of thought. All right. MFC versus POW. Got it. So MFC. All right. Back in 2007, this is a financial stock, by the way. They're like a massive financial company around the world. It's a Canadian company as well. 5.7% dividend. Love it. I own it. And let me explain why. So this stock during the Great Recession fell big time. It fell 80%. This is because the company was like over leveraging itself and honestly not really having that great of governance. Now, in my opinion, this negative view on the company and its financial discipline has remained with it over the past 14 years since the financial crisis because investors saw this stock fall 80% from the company over leveraging itself and taking on way too much risk at the wrong time. However, now over the past decade, this company has really focused on loud noises. This company has really focused on reducing its risk. And I actually think that they're managing risk very well now. So this company is just, it makes so much money and it pays a very nice dividend, and now it's even buying back shares. So we're going to go back to our freeform tool here really quick. We're going to go to mfc.to. And we're not going to use free cash flow. Why? Because it's a financial stock and free cash flow does not work on financial stocks. So we're going to take a look at this company's price to earnings. Zoom in a bit. So the stock is now selling for a price to earnings of 6. And its historical average over the past decade has been 12.18. It had this period right here where it was kind of selling high. So I would say the stock's average realistically is probably it's probably around 11. So it's selling for a very low price relative to its history in terms of its earnings. And also, let's take a look at the shares outstanding. Because this stock really around here in 2018, it started buying back shares as well. And it's reduced its share count by nothing like major, right? But you got to think on top of the dividend. It's reduced its share count by, I think that's like 3%. Yeah, over the past few years. So it's starting to buy back shares on top of the dividend. Sorry, the dividend. So what is this percent return to shareholders? So over the past year, it's returned 5%. Over here, it's returned about 10% during the stock market crash. So yeah, I don't know. I think that this company is continuing to grow over the long term. Take a look at its net income growth. And you can see right here that over the past decade, it's really grown its, let's do from 2013. It's grown its net income from about $1 billion to $7 billion. It's grown its net income at a compounded annual growth rate of 24%. And over this time, like the stock really hasn't done that much. And because the net income is growing so much and the stock isn't growing with the net income, that's why you're seeing the price to earnings ratio just compress all the way down to 6 now. Again, stock price is essentially remaining flat, earnings going up, PE coming down massively. And you can see right here, like this stock, despite its net income growing so much, the stock essentially has done nothing. The stock has grown at 5.8% a year versus net income growing at 24% a year. So, in my opinion, it just seems like the market doesn't want to own Manulife because of its history. And I think that's a mistake because I think the company is much different now than it was 14 years ago. It's growing, it's growing very well. It's trading at a cheap valuation. It pays a nice dividend. And now they're even starting to buy back shares. So, in terms of answering the question, how much cash can this business return to me as a shareholder? It's a lot. Like in Manulife's case, it's a lot. So I'm happy to own it. I don't know if the share price is ever going to respect the underlying fundamentals or not, but man, in the meantime, I'm going to get this dividend and they're going to buy back shares from me and it's going to be awesome. So that's why I own Manulife. They're also expanding into Asia, which I really like. They want 50% of the net income to come from Asia in the future. Oops. Let's remove that. So let's take a look at POW. So over the past decade, this stock price has grown at 4% and net income has grown at 7.6% annually. So not growing as much as Manulife. Let's take a look at the revenue. Let's add in MFC.to. Okay, so we're going to look at our table here. Manulife's revenue has dropped by 4% over the past decade. Let's take a look at the past 5 years. Revenue still dropped. Interesting. So POW's net income is growing slower. It's growing revenue. Manulife's net income is growing faster. So Manulife is growing its profits faster, but not revenue. What about the dividend? Manulife is growing its dividend faster over the past 5 years, over the past decade, growing the dividend faster. So yeah, Manulife, since it's growing its profits faster, it's able to grow its dividend at a faster rate. And it looks like the company's net income is growing faster and the dividend is growing faster. So I own Manulife and I do not own a POW Group or whatever the company's name is. I actually don't know the name of the company. So yeah, we're really going long here. Bye, Sophie. Thank you for tuning in. I know 2 hours is a very long time. Okay, I'm still getting requests for stocks. Take a look at Lending Club. This is going to be the last stock I take a look at, and then I'm going to have to go make breakfast because I still haven't eaten, and it's getting to 1 p.m. We've been recording for over 2 hours now. Crazy. It's fun, though. I'm actually genuinely having a good time. So, Lending Club. What do we got here? This stock is down 72% from its highs. Let's take a look at its financials. Wow, what the heck happened here? Okay, so in 2016, the revenue topped out at 1.2 billion. Then it came all the way down to 400 million, and now it's spiking again. Spiking a lot. What about the cash flow? Cash flow looks like it's growing. What about net income? Net income is growing. Lots of net income. Okay. Doesn't pay a dividend. Free cash flow is there. What's the price? 1.4 billion. Really? Really? Interesting. It looks interesting. It looks like it could be cheap. I don't know anything about this business, but I mean, revenue is coming back right now. Cash flow is coming back. Net income's coming back. So maybe this could be like a turnaround stock. It looks like the business went through a hard time where revenue declined for years, but now it's coming back. So maybe it's a turnaround stock. And I would ask if the cash flow and the net income and the revenue is going to remain at this level, or if it's going to continue growing, or if it's just a short-term thing. Because right now, it looks like the market is pricing the stock as if it's a short-term thing, and that revenue growth and free cash flow and net income is not going to grow in the future. So, yeah, I don't. I would have to dig into this a lot more, but I would try to figure out why this happened. Why from 2016 to 2021, the revenue dropped by like 70 to 80%. And then what happened in the first quarter of 2021 to make the revenue come back? What happened here? And then what changed? That's what I would be asking. And then I would also ask, is this reliable? Is this revenue growth going to remain? Is the revenue going to top out? Is the revenue going to come back down? And really just try to understand what's going on with this business. Because man, if this revenue growth, if this operating cash flow growth is going to stay, and if the net income growth is going to stay, then it does look like it could be cheap. I mean, think about this. It's a $1.4 billion company today, and it did how much in free cash flow? 382 million in free cash flow in 12 months. That's like a 5 times free cash flow. It looks cheap. Looks like it could be cheap. Yeah. Yeah. Those look like it could be interesting here. So those are the questions that I would try to answer for sure. But yeah, everyone, that's going to be all. Thank you all so much for tuning in. We've been going for 2 hours and 10 minutes now. I have to go eat breakfast. I'm sorry, but we're going to be doing live streams every Saturday. And Jake, my co-founder of Stock Unlock, he's going to be doing live streams with us. But yeah, he's in London. He's on a week-long vacation because he needs it. He works way too hard. We forced him to go. And yeah, so he's not here this week, but next week Jake should be tuning back in. But that's going to wrap up the live stream, everyone. Thank you all so much for tuning in for 2 hours. Crazy. And I'll see you guys this week in the videos that I post. I'm going to be posting on this channel and my main channel. And I'll also see you next week in next week's live stream. So thank you all again so much for watching. Truly do appreciate it. Make sure you subscribe to the channel, like the video, and yeah, hope you guys enjoyed. And I'll see you all in the next one. And have a great rest of your weekend.